I'm going to talk about the exchange space, something I've been involved in for about 20 years. So half the time, John's been in the industry, sort of electronic trading and the exchange space. And we've seen a lot of interesting business models evolve and create themselves in sort of day-to-day space like Amazon, and we'll look at Netflix and others. Now, what does this mean in our industry? I mean, it's interesting. The previous talk touched upon potential for that to happen in financial markets. And as John actually presented, for all too many years, the market was relatively stable. We had the status quo. If we go back 10 years, or even if we go back sort of pre-1997, I mean, the LSE, or pre-2007, the LSE was the only major exchange in London trading UK securities as well. And all that's kind of changed over the years. A lot of it driven by disruption. A lot of that sort of being underpinned by technology and regulation that's driven that disruption as well. So if we look at this, I mean, what does Netflix have in common with the exchange space? I mean, we all saw how Blockbuster went out of business recently. And if we look at Netflix, that used technology and online media to challenge existing business models. Blockbuster effectively trading or renting videos throughout its stores. And ultimately, over time, one challenged the other, and ultimately Blockbuster went out of business. And that was purely driven by technology and also changing business model. We speak about the equities markets. I mean, John mentioned the Markets in Financial Instruments Directive coming in 2004, and that was that then actually went live in November 2008. And what that did was it opened up equities markets to competition, whereas before that, UK stocks were traded on the LSE, German stocks were traded on Deutsche Börse, effectively the parent group of Eurex, French stocks traded on Euronext Paris. And more or less 100% of the volume was either traded there or reported, if it was done away from the exchange, to those exchanges. Then new entrants like Chi-X came in, something I was fortunate enough to be involved in from the beginning. Driven by regulation, which opened up competition for new exchanges, new trading venues to come in. They got volume from the existing exchanges and ultimately ended up with about 30–40% of the volume. Now, that was driven by, again, what was that driven by? I mean, it's a classic case of innovators' dilemma. Many of you will be familiar with this book, and it's interesting. It talks about existing companies becoming too complacent and focusing on their existing way of doing business, whereas technology leading some of those existing companies, or technological change leading some of those existing companies to fail because they don't really adapt to the needs or the perceived and future needs of current customers. And this absolutely happened in the equity space. I mean, we've seen that example with Netflix, Blockbuster. We've seen it with Amazon, effectively challenging existing bookstores, and many of them having to, with the overheads they've got of stores and so forth, struggling. And equally, Amazon going forth and then expanding and diversifying beyond books into reselling a whole range of products, and also Amazon Prime and a whole range of licensing and supplies. I mean, we've mentioned Apple. We've seen that sort of rise and fall in a similar fashion. And a lot of it is driven by, everything underpinning this is technology. But actually, the key to that is how technology is used. And all too often in the exchange space, we've been doing the same thing that we've essentially been doing for many, many years. And we haven't really seen a change. I mean, bringing buyers and sellers together, whether it's in a range of derivatives products, whether it's cash equities, charging for the output of market data that exchanges then generate off all that volume as well. And really, that's been the core business, although over the last few years, we've seen some of these exchanges diversify into technology. So, I mean, effectively, how do you create innovation when things have been static for many years? Initially, a lot of the exchanges in this space looked at mega mergers. I mean, the LSE being a case in point, they tried to merge with the Toronto exchange. And ultimately, exchanges, typically the way that they've evolved have been very nationalistic. So there's a degree of protectionism around them by the home country, be it governments or be it participants in the local market. And therefore, we've seen a lot of mega mergers potentially fall through. We've seen more often than not the regulatory approvals, the competition issues that it creates more often than not around big mergers means that the probability of them happening is remote. So typically, exchanges that I think will really do well in this space are those that look at a whole raft of smaller innovations. I mean, Deutsche Börse, the German exchange that also has a minority stake in us now, is looking, they've got a fintech startup challenge, an innovation hub where they're looking at a number of smaller companies, you know, we being a startup, for example, and looking at how they seed those and how a number of potential seedings with strategic investments that they make come together and create a much more bigger holistic whole. Equally, if we look at exchanges, I mean, we mentioned the resistance in Canada. It's much more about partnerships now. So if we look at CME coming into Europe, you know, again, this was held there yesterday. They're coming into Europe. They're trying to compete with the established order. It's proving difficult. Again, they may or may not succeed. Really, they're coming up against incumbent exchanges that have been well entrenched in this space. So they're, you know, again, they bought something called the Singapore Mercantile Exchange. ICE have to do a similar thing in Asia. CME have a presence there. But I think the way that these exchanges will succeed in some jurisdictions, whether it's Asia to an extent, or then after that Africa as it plays out, and Clive, the next speaker, is doing a lot of work on commodities there, is through partnerships. So it's all about working with existing exchanges in existing markets and looking at synergies between them. An example of that being, example of that not happening, for example, is if we look at CME or other exchanges, typically what's happened is they'll go to you a small exchange out in Asia. Let's say, you know, let's take a small market out in Asia, let's say the BSE that's struggling to build up its derivatives volumes, the Bombay Stock Exchange in Mumbai. They'll come to them and say, all right, why don't you list your index derivatives contracts on us? We'll give you a few cents on the dollar, and therefore you'll get volume that you won't otherwise have. But the problem with those markets is it doesn't sustain them because that liquidity is on CME. All the customers are connected to CME. CME are becoming that hub of liquidity. There's no liquidity in the local market, and equally the local exchange is then beholden to the CME and the few cents in the dollar it gets there. So actually it does nothing to actually promote liquidity in the local market and sustain it. The other model, again, not just outlining this because they have a stake in us, because I'm pretty outspoken with these things at the best times, but Deutsche Börse with Eurex have a partnership with TAIFEX, the Taiwan Futures Exchange, where the partnership is during outside of Asian hours, the Taiwanese futures and the open interest for those and the clearing is done on Eurex here in Europe, and it covers European time zones. Then there's a daily rollover on Asia opening, and those same contracts are then traded on TAIFEX out in Asia as well. So you effectively got a market that ultimately, you know, when you factor in US hours, becomes ultimately 24 hours around the globe, but in a way that supports the local marketplace. So it's all about partnerships. It's all about innovation. So what are we doing at GMEX as a small exchange? I mean, if we look at this, I mean, it's really strange in this day and age. I mean, many of you use WhatsApp. You know, we've seen Facebook, and ultimately it's all about the network effect of these sort of platforms, and ultimately you've had the larger platforms buy out the smaller ones because we've seen that traffic potentially move elsewhere, and it's all about capturing that flow. I mean, financial markets to an extent are no different. Many of the large exchanges are striving to capture liquidity, capture that flow, become one-stop shops, but ultimately to the detriment of smaller exchanges. But equally, even many of these larger exchanges that supply their technology, NASDAQ in the US being a case in point, you know, on its marketing with its own exchanges, and externally it reports that it services about 80 different markets. And it cites that one of the advantages there is because its technology is running for its own marketplace, customers are familiar to connect to that technology, and therefore if it's running, let's say in Rwanda, a project that Clive's working on, that it will make those barriers to entry much lower. But actually in reality, it doesn't, because ultimately you've got standardized connectivity. Fixed protocol is a standard protocol in technology that's lowered a lot of barriers to entry, even though there are faster ways to connect. And ultimately what happens is This technology for each of these exchanges is deployed standalone on an island. There's no interconnectivity between any of these markets. There's no network effects of liquidity between any of them, and there's no sustainability, which in this electronic day and age seems inconceivable because we're using the internet day on day. I mean, there's lots of things that we do that are collaborative. Cloud computing being a case in point, and really the model of the future is where some of these exchanges can come together, interconnect, but we're not just talking from a technological standpoint, but we're talking about from a business model standpoint as well. So if we look at it, it's great that you connect the technology that acts as an enabler, but actually no two exchanges are quite the same because they might have different trading models, different trading hours as we've established, different clearing houses that guarantee the trades that are done on the exchange as well, different rule books, different regulatory environments. In Europe with MiFID. All the EU countries were fortunate that they had a common regulatory regime. We've got the same in the US. So it's much easier to create common regulation and therefore a common business model that's passported across Europe. So, for example, if you set up an exchange in London and you're regulated by the UK FCA, then that's passported into every other EU state. And ultimately, clients in those jurisdictions are allowed to trade cross-border into you. In Africa, if we look standalone in many of these markets, remote membership isn't allowed, which means that customers connecting from outside of that country can't connect in to the exchange directly. And much of that is protectionist because it's designed to protect the local brokers who for 50 to 100 years have been protecting that franchise ever since that exchange was in existence. And over time, that will open up, but there's always a resistance to change because those that have most to lose will be most resistant. And if we look at this now, so what we're doing on the GMEX side is we're saying, okay, great, we're launching a new exchange in Q1, and we'll cover what we're doing specifically there on the next slide. But equally, we have technology. Now, how do we use that technology as an asset and work sustainably with some of these local markets, but also use our exchange knowledge to then ultimately interconnect those business models and bring liquidity into those local markets that we and the local exchange mutually benefit from, enabled by common technology. So effectively creating that interconnectivity as we move ahead. And then in that network, each exchange can be connected to other exchanges in that network. So you create a global hub of liquidity and you create a multitude of products that can be traded across it with that network effect. And that's something that we're now doing. We've announced something with a small exchange, Alltex in Uganda on cash equities. There's other things that we'll be doing both in the derivative space and in the equity space. So, and what are we doing over here? So, again, John mentioned the G20 reforms, and there's something called the Markets in Financial Instruments Directive 2, which MiFID 1 was particularly only specific to cash equities. MiFID 2, after the financial crisis, we saw Lehman Brothers go down. We saw Bear Stearns go down. We saw systemic risk across the system. And there's something invoked called the G20 reforms. And ultimately, this talks about central clearing and transparency around a lot of those OTC derivatives trades and activity that John spoke about in his talk, and a whole regulatory regime around that. And we've seen Dodd-Frank, and ultimately this is an iterative process, but that in its first form is live in the US. We've seen Emir mentioned in the last talk, the European Market Infrastructure Regulation with central clearing, and we've got that being mandatory for all trades that are OTC in standardized derivatives contracts. They're going to have to be centrally cleared in the middle of next year, almost about 2 years after they have done in the US. With that, it presents a problem because if we take the interest rate swaps market, it's a huge market. You've got $500–600 trillion worth of open interest annually in these contracts. And ultimately, if we look at the vast majority of those contracts have to be centrally cleared, they're vanilla contracts. If we look at the balance sheet implications of centrally clearing those, many of these are long-term contracts, up to 30 years, some even up to 40 or 50 years. The amount of collateral, the amount of margin it requires is immense. And actually, if we're looking now on the buy side, we're looking on the sell side, there simply isn't that amount of capital. There's effectively a capital shortfall across the industry. So this again, it's all driven by regulatory change. It's driven by the financial crisis. And that actually presents an opportunity to create products that mimic the OTC products, but traded on an exchange, create transparency, but actually from a margin and collateral perspective, it's done at 80 to 90% cheaper cost than the existing OTC products. And that creates, that's very disruptive to the existing way of doing things. Typically, who does it affect? Who are the losers if this happens? Well, initially, the banks on their fixed income desks have made a huge fortune with the market being less transparent over the years. We've seen in fixed income currencies and commodities profits that have been very, very large. And as equities profits have eroded with competition and transparency, that's where a lot of the banks on trading have made their money. So effectively the sell side. But ultimately now with these new reforms, even the banks themselves that then hedge that risk they take on themselves on their books with those OTC trades also need a cheaper way to hedge their activity. So initially, we've come up with a product that allows a cheaper way to do that for interest rate swaps with a futures product on exchange. Initially, when we started this 2 years ago, most of the sell side, a lot of the large banks tried to shut us down and not make this happen. But ultimately, over time now, many of these banks have realized that they need these products as well, because that franchise is already being eroded by some of the buy side taking on more control over their activity. The interdealer brokers who typically sit between the banks and have facilitated that liquidity amongst those OTC products because they haven't been transparent on exchange. They're in a situation where a lot of their activity was done over voice trading, even though some of them are moving to electronic exchange-like platforms, and they've seen their profits tumble. So names like ICAP, Tradition that you might see out there, Tullett, Prebon, that have all facilitated the sell side. And many of those have realized actually they've got to move and diversify their customer base. But they're stuck in the innovator's dilemma because they get the majority of their revenues from the sell side. And if they try and disintermediate the sell side and go to the buy side, the sell side will then pull their revenues from them and effectively go to some of the other IDBs that don't do that. So they're in a catch-22 situation where they're stuck in this classical case of innovator's dilemma where even if they realize that change will affect them, they're in a difficult situation to see how they shift to that and conform to this changing business model. Some of them are trying to do it. Certainly, the likes of Tradition and others are going up the chain to the buy side. Others aren't. Equally, some of the sell side banks are reinventing themselves as well. And you're beginning to see a degree of consolidation in this space, especially on the clearing side, where you need the biggest balance sheets. So you've seen independent clearers like New Edge being bought out by Societe Generale, the large bank, because this is all a balance sheet game, and you need economies of scale here to survive, given the environment. Now, in this space, it's interesting because there's going to be a range of futures products that come out to mimic the way that OTC products are done. What we're doing at GMEX, everyone's doing things a certain way, the way that they've always done them. So they're converting OTC products into effectively a standard future style construct, which talks about quarterly expiring futures contracts and effectively is designed for bond style futures, which go back to these things existed if you go back to for things like bringing your cattle to market, and that's why they're quarterly expiring, or delivering the weird metals that you didn't want that John spoke about that landed in your backyard. It isn't really designed for the current way of doing things, doesn't really relate back to the OTC markets. So whilst everyone's going this way, we've decided to create a contract that's less futures-like, but more mimics the OTC markets, and so we made a call on that. Only time will tell, as John outlines. There's a huge amount of play in this space, and actually there are going to be winners and losers over the next 4 or 5 years. In the 20 years that I've been involved in financial markets, actually this is the most fascinating time ever, I could argue, because the opportunities are immense, and actually the disruption is the largest it's ever been. And actually it's a good time for many of you that are going to enter their industry in the next 1 or 2 years, because actually you're coming into an environment that's very fluid, very exciting, and definitely won't be static. So I think it's definitely time to think outside the box. It's time to challenge the existing way of doing things. And actually, it requires a lot of fresh thinking, a lot of fresh thought. And actually coming in, not having an incumbent thought process presents a lot of opportunity if you're fortunate to get involved in some of these changes. And actually, then we can all watch the dinosaurs effectively die out. Thank you.